CAPM capital asset pricing model. This is our next topic. Now, this method is used to calculate the cost of equity. So far, you know that we already have done or calculated cost of equity using the dividend valuation model. So actually, for calculation of cost of equity, you have two approaches. One which is called dividend valuation model, and the second one is called CAPM capital asset pricing model. Within dividend valuation model, you again had two options. One was the constant dividend, and the other one was the dividend valuation model with growth, constant dividend or the growth model. So anyways, we have done both of them. We leave them on one side. Now we talk about CAPM. And before we go into details, let me just tell you that CAPM is the method which is most commonly used. Although we do use dividend valuation model as well sometimes, but primarily CAPM capital asset pricing model is preferred. Why? We will discuss it here. So it says that the dividend growth model gives empirical estimates of cost of equity. It measures the dividend, then which is like the last dividend, then share price, which is the X dividend share price, and the growth rate, which was G. So when you had these three things, you could calculate cost of equity. Okay. Now it says that it does not explain why KE is different for different companies. So first of all, KE is the expected return or the return which is expected by the providers of equity finance, which means the shareholders, the equity finance who is providing, how much return do they expect from you or from a company? And then the question is that why do they expect a different return from different companies? For example, I'm one shareholder and I invest money in company A and I say I need 10% return. And then I'm the same person taking out money from the same pocket and I give it to company B and I say from you, I expect 14%. So I'm the same person, it's my own money, but when I give it to company A, I'm happy with 10%. But when I give it to company B, I'm probably asking for 14% or 15%. So why there is this difference there? So the reason for this is actually the risk. If shareholders or equity providers they see more risk, they started asking more risk premium. Okay, because company A offers less risk, I'm happy with 10%. But company B is asking, is offering more risk, and I'm actually going to ask for a high risk premium. I tell you from my own personal experience. It's not only about the nature of business itself. Sometimes it is the economic or political environment in which the business operates. So when I was working, we were doing the same project. For example, there is some processing which we used to do for oil and gas. So I would not like to take the names of the countries, but in one country we had this setup, and we our cost of equity there was like 11 or 12%. We were happy with that 12% return. But the same project, when we start in another country, which in our understanding has a little bit more of environmental risk with regard to political and economic environments, we were looking for 17, 18%. We said, okay, we are not going to invest there unless or until we get some additional risk. Why should we go into that environment? So this is the reason that we so through CAPM we will try to answer this question, that same investors investing in different companies or different businesses or in different countries, they are looking for different returns. Their cost of equity changes based on the risks which are associated or attached to that particular project or to that particular business. The capital asset pricing model addresses the causes of the cost of equity and is an alternative approach to calculating KE. CAPM asserts that different companies have different costs of equity because they have different risk, and we will actually try to split them and understand what are the different risks and how do we calculate the risk. So this method, we will always, not only we will see that what types of risks are there, but we will also try to learn how to calculate or how to quantify those risks. Because you can say that there is a big risk, but then you have to quantify. There should be a measurement of risk. So we will learn how to measure the risk as well. Higher risk means higher return. That's very normal. If risk is measured, then it should be possible to predict the return that shareholders should require. So this is what is actually we should be doing here. We have to measure the risk. You cannot just say that risk is more or risk is less. You have to quantify it. You have to give it a number. Okay, like everything has a measurement, right? We have measurement for weight, we have measurements for distance, we have measurement for money, we have measurement for everything. We have to attach value to the things. So to the risk, we also have to find out the value. First, we say that there are two types of risks: unsystematic and systematic. Okay, so total risk divided into unsystematic risk, also known as specific risk. These are the random events that affect one share only. Example, a drug company making a breakthrough. So remember that unsystematic risks are associated with one company with one share. Okay. Um, it's a specific event. Whereas the systematic risk, these are the random events that affect all shares. Example, economic news about one country can affect all stock market within that country. I mean, if you talk about, remember that a few years ago, we faced that COVID-19 thing. So that was a random event, and it did not affect only one specific business or one specific company's shares. It actually affected everyone. So we call it systematic risk. So this is a risk which is attached to the system, the entire system. Okay. Unsystematic is for one company. That one company is facing or some trouble because of some events which are happening to that company only. Unsystematic risk, the first one, can be diversified away. How can you diversify? For example, I go into auto sector, and then you have, or maybe some other sectors as well, any sector. So diversifying means that you actually, there is not like a fixed number, but there is an assumption or there is a belief that if you, uh, keep 30 different types of shares in your pool, you can diversify the risk. Because what can happen that if one share is going up, the other one is gaining. You lose from one, you gain from other. I mean, you invest all of your money in one share, it goes up, it goes down, you face the risk. But if you divide your investment portfolio into multiple shares, multiple companies, and there is a belief that approximately 30 should be there minimum. So if you diversify it, it means you can diversify it by investing it in multiple projects. This is unsystematic risk. We call it diversifiable risk. Systematic risk cannot be diversified because systematic risk, whether you have 30, 40, 50, the entire environment is affected. Everyone is affected. Okay. So if it is going into recession, everyone is facing the heat. If it is going into boom, everyone is enjoying. So unsystematic and systematic. Systematic risk cannot be diversified away. All shares are affected. Now, this is risk, total risk variability of return. So we put the systematic risk at the bottom, and then on the top, we put the unsystematic risk. So systematic risk is the one which is faced by all the companies. So at this level, this is the risk which is faced by everyone. This is inherent risk. Okay. I'll give you an example to make it easier. There are some countries where business environment is very transparent, government policies are very conducive, and market is very certain, and things are very predictable. Government is stable, political environment is stable, economic environment is stable. This has a different systematic risk, which is very little. On the contrary, there are some other countries in which there is a turmoil in the political environment. Political environment is not stable. And every time there is a new government, there are new economic policies coming in. So economic environment is also not stable. So the inherent risk going into that country is more. Okay. So I choose country A and I choose country B. Country A has low systematic risk and country B has high systematic risk. So if I go to country B, every company in country B has a higher systematic risk. And then you go into that country with higher systematic risk, and then there are different companies, they have their own risk. Now, within that country B, Then you choose which type of business I'm going to do. So if you go to a retail sector which has low risk, or you go to probably a software development which has a higher risk, so that comes the risk which is attached to the business, and together it makes your risk. Okay, so your total risk will be the risk which is the systematic, which is everyone is facing, and then this part which is unsystematic, this is the risk which is faced by a specific company or by a specific share, and this becomes the total risk. Okay, so the total risk is divided into two: systematic, everyone is facing, so I go to a country which has higher systematic risk because of its unstable political environment, but then I decide or choose to invest in a business which itself is stable. So I have a choice that I'm going to probably a dangerous environment, but in a dangerous environment, I'm doing a safer business. Or maybe I may decide to go into a very risky environment, and then on the top of that decide to do a very risky business. So I'm facing higher risk. Okay. So systematic, unsystematic risks. CAPM deals only with the systematic risk. CAPM deals only with the systematic risk, which is not diversifiable. To use this model, investors must have a well diversified portfolio. So this is the thing which we are taking care of. This we say is related to the nature of business itself. So we only talk about the systematic risk, which is about the total shares. CAPM risk and return. The following measurements can be made. Investing in a risk-free investment will earn the risk-free rate, because we say that, okay, this part is, everyone is facing. So if we go there now, we invest in a risk-free environment. Investing in a risk-free investment will earn the risk-free rate. So you have to learn some terminologies or variables. One is called RF. I have said it multiple times that we call it a risk-free rate. Actually, there is nothing in reality as risk-free. Everything has risk. But we assume, for the sake of academic purposes, theoretical purposes, that there are some investments which are risk-free. And this is the rate which is offered, or the return which is offered by the risk-free investment is called the risk-free rate, which is always the lowest rate. We call it the government bonds. Now, again, a question comes up. The bonds issued by which government? Are these bonds issued by Brazil or Cyprus, where bonds are actually almost going close to, default or what? So anyways, like I said, that we assume that the government bonds are risk-free. Investing in all shares in the market will earn the market rate of return, which is called RM. So one word you learn RF. The second word is RM. RM is the average return given by the market. For example, if you go to a specific company, a specific country, it has its own stock exchange. On that stock exchange, there are 100 companies. Some companies are giving more return, some companies are giving less return, some companies probably are giving no return. So you have a portfolio of 100 million. You invest 1 million, 1 million, 1 million in all of the 100 companies, and then you see that how much average I'm getting. This is called market return. So market return is the average return offered by all of the companies together. Okay, so the best way is that you invest in every business, just like you invest in index funds. You invest in index funds. Sometimes you invest in Standard and Poor index fund and so on. So when you do that, you are actually investing in everything. So you expect that if the market will grow by 8%, I will also grow by 8%. So I'm not dependent on the growth of one business. I'm not dependent on the fortunes or losses of individual companies. It's the market growth which I'm getting. So market return is the average return given by the market. And then we have the market return will be enough to reward investors for the systematic risk of the market. This is given a beta value of 1. Now, this is you need to understand, okay? This is the point where we have to build our foundation. We say that the market is giving an average return, and that average return is called RM. And then the companies which are working in that market, and together all of them are giving me the risk, the market return RM, these companies also have risk. So some of the companies have higher risk, some companies have lower risks. Okay, so not all companies have same risk. So I've got 100 companies, they give 100 different return. Some companies are giving 17% with higher risk. Some companies, they offer 15% with lower risk. Some companies are offering, for example, 10% with further lower risk. Some companies are giving 25%, but they also have huge risk. So when I take the returns and I take the average of return, I call it RM. And when I take their individual risks, all of the risks together, and I take average, that is called beta value, and that is equal to 1. So a beta value of 1 is actually what? This is the average risk by the market. Okay. So if you are earning market return, you are facing the average risk of the market, and the value of that average risk is equal to 1. Okay, the value of this average risk is equal to 1. So imagine that the market return average is, let's say it is, I don't know, it is 10%. If it is 10%, the beta value for that is equal to 1. So if there is any company which is offering a more return, for example, some companies offering 12% return, so their return is more than the market, their their beta value will always be more than 1. So the beta value would be something like probably 1.2. If there is another business which is offering 8% return, which is less than the market return, then its beta value should be less than 1. Its beta value probably will be, I don't know, maybe 0.85 something. Okay, so you always set 1 in the middle. This is the average return and the average risk, which is called beta equal to 1. And if you, for example, if you say, oh, there is a business which is offering which has a beta value of 1.4, I say, oh, beta value 1.4, that's significantly greater than the average risk. So then my return should always be more than 10%. I'm looking 18%, maybe. So how to calculate this, we will see. So this will depend on the beta. So the beta value will ultimately decide the return which you need. Okay, so any business which is offering, for example, RM is, for example, my market return is 10%, and there is a business, a particular, and I know that this 10% means that here beta is equal to 1. So there is a business which is actually, I say, okay, this is company Alpha company. So Alpha company, what is their beta value? So I find out the beta value of Alpha company is 1. I say, okay, for 1 beta value, I'm happy with 10%. There is another company which is called, I don't know, the Gamma company. So the Gamma company, what is their beta value? I find out their beta value is 1.3. So since the beta value is more than 1, which means the risk is more than the average risk, I say I also need return more than the average return, because I'm probably looking at 13% or 14% or whatever. Why? Because I'm taking more risk, and therefore my return will also be more. Okay. So this is the relationship between the risk and the return. So we, of course, through this discussion, one thing we find out that if we need to see that how much return the shareholders are expecting, the cost of equity, it depends on the risk which they are taking. And how do we calculate risk? With beta. And do we have some formulas for calculating the betas? Yes, we do. We will see that. The returns from specific investments will be logically related to RF and RM, by them beta value. So RF, what is the risk-free rate, what is the market rate, and what is the beta value? These are the 3 variables which will decide. Okay, what is the risk-free rate, which I mean RF. On top of that, there is the risk which I'm taking, and for that risk, I need some premium. So this is actually the graphical explanation of that, depiction of that, that when you have the market return, for market return, the beta value is equal to 1. Okay, so there are some companies which are offering lower. If I think about a company which is giving this much of return, so then their beta value will also be less than 1, probably 0.9. If there is a company which is offering this much of return more than the market is giving 12%. This guy comes in and says, I'm giving 16% because his beta value is also more than one, maybe 1.8 or whatever. Okay. So it's a very simple explanation. So this is the formula actually which we have. So we said that we are using CAPM, cost of capital asset pricing model, to calculate the cost of equity. And the calculating cost of equity, the formula will be RF, which is risk-free rate, plus beta value, multiplied by RM minus RF. Okay. So they tell you that risk-free rate, RF, is 4%. RM, which is the average market return, it is 9%. So you say, okay, I put 4% here plus beta into RM minus RF, which means 9 minus 4%, which is 5%. So when I put value of beta here and I multiply it, this is the return, or this will be the cost of equity which we need to calculate. So everything actually ends up with the beta. Average return I can calculate from the market. Risk-free rate is always given in the environment. If I only could calculate beta value and I multiply it with this one, and this is thing actually called equity risk premium. Okay. RM minus RF is called, so RM is market return, RF is risk-free rate, and RM minus RF, this thing, this component, which is actually 5% in this situation, this is called equity risk premium. So sometimes in exam questions, they tell you that RM is 9% and RF is 4% or whatever. And sometimes they don't tell you these numbers. They tell you that equity risk premium is 6%. So when they say equity risk premium is 6%, you understand that the difference between RM and RF is 6%. For example, in this question, equity risk premium is 5%. So it is possible they don't give me this RF and they don't give me RM. They just tell me that equity risk premium is 5%. So I say, okay, it means that RM minus RF is 5%. I don't have these values 9.4. I only have RM minus RF. It is called equity risk premium. The name says it all. Equity risk premium. So the premium which the equity shareholders are demanding to take the risk. So if I'm taking some risk, I'm an equity shareholder, I'm taking the risk. How much premium do I get? Which is above than that from the risk-free rate. Okay, so RM minus RF. Then we have got this, again, a very similar, the same thing, the same figure, but it explains that beta value is greater than 1. Share is relatively volatile and risky. If your beta value is greater than 1, it means that this particular share is taking more risk than the market average risk. Okay. Example, a company making capital goods will have a high beta and high return. What are capital goods? Capital goods are the non-current assets. And they always face actually higher risk because people, they stop buying them as soon as the economic activity goes down. For example, cars. For example, houses. For example, electronic goods, refrigerator, televisions, maybe furniture. All these are capital goods. So if you feel that there is some kind of economic downturn, economy is not doing good, and people, their incomes have gone down, what do? First, they don't stop eating bread. They say, okay, my income is going down, so I will not change my television, I will keep on using my old furniture, I can wait to buy new furniture for another 2 years, let's not change the car, or maybe let's not buy a new car. So capital goods are always hit first. And therefore, for capital goods, if you see the companies which are manufacturing these capital goods, their beta value is always greater than 1. And their returns are also always more than the average market returns. If beta value is 1, a share is less riskier and stable. A low risk, a supermarket company will have a lower beta because supermarkets, what do they sell? They sell groceries, they sell everyday items. So even if incomes are going down, supermarkets are not seriously affected because the things supermarkets are selling, these are the things which people need to survive or to live every day. So you don't stop eating eggs or bread or cheese or whatever. There might be a little change in demand that you say, okay, I'm not buying an expensive cheese, but I will buy a probably a low price cheese, but you still will buy the thing. So supermarkets, they face less risk, and therefore their returns are lower than the market average return, and their risk value is always lower than the beta value of 1. Okay. So this is an introduction, a 25 minutes long introduction to CAPM, capital asset pricing model. We will continue the calculations now. We'll see how to put the numbers and how to find out the cost of equity using some questions, some examples, um, to how to calculate cost of equity. And that we will do in a while in another session.